All right, let's get into it. Today, we're diving deep into Enbridge's third quarter earnings call. And this one's a really interesting case study because what you saw on the surface, well, it was completely different from the real story that unfolded once you dug in. So here's how we're going to break it all down. First, we'll tackle that headline versus the real story. Then we'll get into the nitty-gritty of the Q3 numbers. After that, we're looking inside the growth engine. What's really driving this thing? We'll figure out why the market flipped from bearish to bullish. And finally, we'll wrap it up with our own rating and what we're looking for on the next call. Okay, section 1, the headline versus the story. And this, folks, is a classic case of market misdirection. Okay, so here's the fundamental disconnect, right? On one hand, you have the headline number, an adjusted EPS miss. They reported 46 Canadian cents when the street was looking for 51. That 5-cent miss is what all the algorithms and initial news reports jumped on. But, and this is a big but, the real story was that they posted record Q3 EBITDA and, maybe even more importantly, told the market, hey, our full-year guidance, we're sticking to it. And you can see exactly how this played out in the stock price. It's like a tale of two sessions. In the pre-market, as soon as that EPS miss hit, the stock dropped about 1.5%. But then, the conference call happened. Management started talking. And look at that reversal. The stock clawed all the way back and closed the day up almost 1.8% on some pretty heavy volume. So you gotta ask, right? What on earth did management say on that call to completely flip the script? What did the smart money hear that made them ignore the headline and start hitting the buy button? Well, to figure that out, we need to dig below the surface. Okay, let's get into the numbers, because the real answer was hidden right here in the core operational strength of the business. So take a look at this. You can see the divergence plain as day. Yeah? Adjusted EPS missed by that nickel, and management explained that was mostly due to higher financing costs, interest rates and some other non-cash items. But look at the next line. Adjusted EBITDA, a record for Q3. That's the pure earnings power of their assets. DCF, or distributable cash flow, was basically flat, which is solid. And their debt levels, 4.8 times, smack dab in the middle of their target range. No red flags there. And this number, this $4.27 billion, this is the number that really mattered. This is what investors focused on, a record Q3 EBITDA. It told them that despite the noise in the EPS line, the actual physical business of moving energy is humming along better than ever. And if that last number was about the present, this one is all about the future. $35 billion. That's the size of their secured capital project backlog. And let's be clear, this isn't just a list of stuff they hope to build. These are secured, largely de-risked projects that give you a super clear line of sight into where their growth is coming from for years. So, a $35 billion backlog is great, but where's that money actually going? Let's pop the hood and look inside the growth engine. First up, liquids. Their mainline system is an absolute monster. It moved a record 3.1 million barrels a day in Q3. But the real story here isn't just volume, it's efficiency. They're not building brand new, super expensive pipelines from scratch. Instead, they're doing these Mainline Optimization, or MLO, projects. Think of it like adding new lanes to an existing highway. It's a brownfield approach, super capital efficient, and it gets that new capacity to market way faster. Then you've got the gas business, and the theme here is just massive accelerating demand. Part of that is from LNG exports. They're expanding their storage to help feed all those new terminals popping up. But the other part, and this was a huge theme on the call, is the insane power demand coming from data centers. Think AI, think cloud computing. That stuff takes a ton of electricity, and a lot of that electricity is going to come from natural gas. And don't just take my word for it. Here's the CEO, Greg Ebel, spelling it out. He's saying this isn't just a small trend. The growth from data centers and AI is going to drive demand for all their commodities. He sees it impacting the entire system. That's a pretty powerful statement. And this theme of powering the digital world doesn't stop with gas. It flows right into their other businesses. Their gas utility has a line of sight to serve a huge amount of new potential demand. And check this out. Their renewables portfolio is selling power directly to the tech giants themselves. We're talking Amazon and Meta. They are literally helping to power the cloud. Okay, so let's put it all together. Why did the stock reverse course? Why did the market buy in? It's because they looked right past that noisy EPS number and saw a really clear, believable, and de-risked story about future growth. And it's not just a long-term story. Investors love to see near-term catalysts, and Enbridge laid out a few big ones. First, that Mainline Optimization project. We're getting the final go-ahead decision this quarter. That's huge. Then you've got rate case settlements coming through, which locks in their revenue. And of course, everyone will be watching to see them turn that $35 billion backlog into actual cash-flowing projects. And it wasn't just about growth. It was about de-risking. The market saw that the balance sheet is in good shape. Leverage is manageable. They're making progress on some tricky regulatory stuff, like with Line 5. And when management comes out and says, we're going to hit our guidance for the 20th year in a row, well, that just oozes confidence and gives investors a solid financial floor to stand on. So, when we put all the pieces together, what does it mean for the stock going forward? It's time for our rating. Given everything we've seen, the operational strength, that huge backlog, and the powerful macro tailwinds from power demand, we are initiating our rating on Enbridge with an outperform. And here's why, broken down simply. 1. You've got a clear line of sight to about 5% growth every year for the rest of the decade. 2. That $35 billion backlog isn't a hope, it's a reality. 3. We still think the market hasn't fully priced in just how big this data center and AI power demand story is going to be. And 4, management is just executing. They're doing exactly what they said they would, focusing on smart, high-return projects. Okay, so for those who are a little more active, here's a potential trade idea to play this thesis. You could look at a call spread. Basically, you're buying a call option to capture the potential upside if those catalysts hit, like the MLO decision. But to lower your cost, you'd also sell another call option, further out of the money. It caps your potential profit, sure, but it also makes the trade cheaper and defines your risk right from the start.
This is not financial advice.